Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, everyone. Ira Epstein, and here we are, and this is Tuesday, the 29th of November, 2011, getting ready for Chicago snow. Yeah, you heard me. That's what they're saying. We had a down day tonight in the stock market, but a mixed bag during the daytime. The gold market finished up $4, but silver went nowhere, down about 30 cents, and the copper market up almost 2 cents. What I spent my day doing and why I'm coming out at 4:30 in the afternoon is I've released my new charting course. And to me, this has been a big project, almost 5 months in the making. 37 video chapters. I hope you like what you see. I've lowered the price of the course dramatically, put in more information than I ever had, even going to include our handheld device that will play the videos, both these videos that you're seeing, and when you get the course, my webinars, and those will be included free when you start the course. Course is very inexpensive, comes with a money-back guarantee. I think you'll find fact and fun with it. How you get that, and it's what I do with all these charts behind me. Well, you get it by going to our website at www.iraepstein.com. Under the word education, read about it and purchase it right there. Okay, so let's take a look at what happened today. Today is one of these days where the dollar fell, the gold went up a couple of dollars, and the euro currency rallied a little bit. Whoop-de-doo. I don't know that it means a darn thing. I think this market is caught. I had on today Mark Leibovit of vrtrader.com, and Mark and I were both talking about the same thing. You know, as far as I'm concerned, gold's magic number is 1621.70, the close of July 31st. By the end of December, in bullish years, the market is higher than that price. It's about $80 higher when you look at it right now. In fact, it's $1718.90. So it would have to fall all the way back right in, and remember, this is the Fed contract, right into this general level here, which is the 1620 area. You know, it could. The market isn't getting any play out of the fact that in Iran, we saw the British embassy overrun by students there. Government did very little. I think they wanted that to happen. There's reports of bombings yesterday that happened in certain cities in Iran, ideally missile cities, and it wouldn't surprise me if the Israelis are doing something there to stop the nuclear development in one way or the other. And there's mischief going on. That mischief has been going on a long time. Supposedly, today and tomorrow, the EU is taking up the idea of sanctions on Iranian oil. You know, that's not what you have to do. Just stop all banking transactions. The U.S. should stop it. Stop the Iranian central bank from doing business with any of the Western countries. What could be easier? Strangle the country. Let them deal with China and Russia if they can. You'll find very quickly that there are ways to do things, and I just don't understand this, if you will, pussyfooting around with this situation. It's not something that should be walked upon lightly. Killing lives, no. You got to make the sanctions have more bite. So the gold rallied a little bit, but where's it gone? If you look at this chart and forget that it's gold, you had a market that came up, it's set back about halfway from the bottom here to the rally, and it's just sort of sitting. What's bothersome is knowing that it's gold, and you've got these world events taking on, and the market's not rallying. 4 months ago, if you would have heard that the emergency meetings of the EU, the embassy takeover, the threat to oil, you'd think this market would be gone. That's why it's so important to understand market psychology. I like to take a chart and dissect it using this tool called a swing line. I think it's the most important trading tool there is. I don't think there's any tool more important because in a distinct way each and every time it measures apexes of highs and lows, and you look to see if there's a pattern. What's an uptrend? Higher highs and higher lows. What's a downtrend? Lower highs, lower lows. What's not known? A higher high and a lower low. Well, right now you got the combination of higher bottoms, higher tops. So that's a bit of an uptrend going on there. But the market's filter, which is the 18-day average of closes, the way that I teach charting, says that no, when you're under that 18-day average, this is called a short covering rally, but it's not necessarily the beginning of something bullish, and you're not supposed to be a fresh buyer. This is what I teach in my course, under that 18-day average of close. It's one thing to get out of shorts. It's another to try to be a buyer. And what I certainly have zero interest in is trying to buy every little peak, if you will, to get to a higher one, or sell every little valley to get to a lower one. That won't work. You're going to get bounced around. You got to play these intermediate swings, I think, with filters on them. And the filter saying be neutral. All the market has really done is run in between the 45-day average of closes, the blue line, and the green line, the 100. Let's assume that it runs to the 18-day average. Well, that would be good because we still have a seasonal, and I was talking to this today with Mark Leibovit, that carries into early February that is bullish. So if it did that, maybe we'd develop a market that trades between the 1750 area and the 1700 zone, between the 45 and the 100-day average of closes, right in there. That's very possible. Certainly not doing anything violent one way or the other. Each time the market's either hit the Bollinger Band top or bottom, what's the market done? It's turned away from it. It ran for a while against it right here, and that was off that big break low that we had, and the one I was telling you about at that 1621.70 level, where I thought you'd get a pop. And knock on wood, customers that followed my recommendations, not we, you, that followed my recommendations, you were able to take advantage of that. Now right here, you've been out of the market. Now you're taking a look, what do I do next? And I don't have the correct answer yet. In fact, I don't have an answer wrong or right. I don't know just yet. When I look at momentum on the slow stochastic study, it's in an oversold condition, trying to lift itself up a little bit. But once these readings get over 30, and they're at 30.92 and 29.47, anything where they're both over 30, they're already out of oversold territory. So I'm not looking for much more than that red line before the market encounters more resistance. Then I'll take another look and see what happens. Silver, on the other hand, well, it's still in the 26 stochastic range. It still has a clear pattern of lower highs. It's trying to trade within the Bollinger Band. There's just nothing going on. To me, the big important factor here is it's under the 18-day average, and the gold is under the 18-day average, which means you're looking for potential sell signals, not potential buy signals. When I add the platinum, you're looking for a potential sell signal. You're under the red line, the 18-day average. This market's got a bit more bearish things happening. It's trying to take its stochastics and embed them. When you get the red and the brown, which they are now both under 20, and they stay that way several days, I start looking for these bands to do the opposite, bend out, and for the prices to drop down. In the copper, it's been a nice, neat rally in the March copper. So what? You're under the 18-day average of closes. I feel good that I was interviewed. I've been in the Journal a number of times recently, Dow Jones, where people will ask what I think. And I keep saying the $3 to $3.40 level, for whatever reason, seems to be where copper's found a home. And the problem is it has no legs to it up or down. It gets over the number, doesn't go anywhere, comes back under, doesn't really go anywhere. It's more of a drifting market, not really doing an awful lot one way or the other. This market is interesting as can be. This is the March S&P. And in the March S&P, not the DEES, because you're already going to be approaching December in 2 days or so, well, you can see the market still got the pattern of lower highs. Certainly the lower lows are at work, but you can see that one of the numbers that make up the slow stochastic is oversold. So I look at the market, I have a bearish flavor to it. Why? You're under the 18-day average, still got a bearish pattern of lower highs, lower lows, but you're oversold. So I don't see anything really to do there. In the sugar market, ta-da, I think sugar is on the verge of making a bottom, maybe a very big bottom. This is a market that I, frankly, didn't think was going to get that low. But once it started hugging this Bollinger Band, I think I was the first one to bring up these charts here and start saying this is a bear market. That bear market, in my opinion, done. Why? You'd have to take out today's low, 22.89, because you had an outside day up, in order to say that this was any more than short covering. This could be more important than that, and maybe this market's going to get back up to the 18-day average, which is currently 24.47, but it's going to drop a bit each day. It won't have to rally as much as you think to hit that number and regroup. But right now, this big slide in prices, I think you've seen the end of that, and I think the market's ready for a transition change. I am not saying buy it. It is under the 18-day average. I'm saying very clearly, don't be short it. Very big difference.